Jim, the other day someone on Stock Picker wrote me and they wanted to know, given the market volatility, how to deal with the psychology of loss. And again, we've had a market that's gone almost straight up from March 2003 or October 2002 to now. And so for the first time, people are really experiencing incredible volatility. They don't know how to psychologically, young people don't know how to psychologically deal with it. What do you do to deal with it?
Well, I think one of the things you have to do, first of all, with a stock that's a big dollar amount, which we have a lot because the market's been good, you have to divide by 10. So, I mean, those who are panicking on Goldman because it went from 200 to 180, well, I mean, that went from 20 to 18, which we don't find that intimidating. So I want you to divide by 10. And I also feel like that one of the things that people have to recognize is this is the way it always was. And so therefore, maybe they're not psychologically suited for the market. And it's okay.
How do you train yourself, though? Because they're not psychologically suited because there's been no experience.
Well, I think one of the big things you have to do is stop looking. Start thinking about your company. Stop thinking about the stock price. Like people are saying, Jim, you're obviously holding on to Sears and Goldman way too long. And I say, well, look, I'm looking at the people behind Goldman, Lloyd Blankfein, and behind Sears, Eddie Lampert, and I'm saying, well, they're good, and I'm banking with them. That could be wrong. I mean, another thing you have to recognize, James, is it could be wrong. When everything goes up, everybody looks smart. Now, we're wrong a lot, and that's okay.
The tide's coming in.
Right, that's okay. Well, tell me what you do.
Well, I agree with you that the key is to not look every day. Now, I used to day trade minute by minute, and I kind of made my living in 2002, the worst period to do this, just day trading, and that is brutal. I'm about to turn 40 years old in a few months, and I cannot do that anymore. I had to stop, so that's why I migrated to the fund of funds world, because in the fund of funds world, I don't even really know how they're doing on a daily basis. So psychologically, it's a lot easier.
Well, let me ask you, when I go into the question section of Stock Picker, there's so many people who are perturbed by a decline. Don't you think that those are people who really have to get a little perspective, because declines are part of the long-term trend?
They are part of the long-term trend. We're having a normal correction, is my belief. And we could have discussion about this, but I'm not as much convinced that we're having a huge housing crisis or subprime crisis or whatever. And I think now you find the good stocks paying good dividends, good insider buying, steady growth, and in the long run, you cannot go wrong.
I mean, I just recommended Vodafone yesterday. I mean, if Vodafone goes down because of this problem, then that's a buy. I mean, in other words, if you find the companies that aren't involved with morass and they go down, I'm going to contrast this with a second. Then I'm looking at GlaxoSmithKline. If I could find a reason that when it gets to 4% that I'd recommend it, I would just recommend it because 4% is terrific. Versus Thornburg Mortgage. That stock went down from 28 to 10. It was never a buying opportunity because they're in ground zero. But away from the epicenter of the problems, there's been some tremendous buys created, don't you think?
What about Bank of America, which I do think is a tremendous buy?
Well, Bank of America is actually a deposit institution that will do fine.
5.4% dividend
It's
yield.
a deposit institution. The Fed is not targeting deposit institutions. It's targeting companies without deposits. Does that mean that Bank of America can go to 45? Yeah, but that would mean you would buy more.
I agree.
Bank of America, I mean, we're dealing with a world where there's survivors and non-survivors, and Bank of America is clearly a survivor.
Well, people want to be up in their portfolios every single day.
That's the issue.
That's the problem. Sometimes it's actually good to be down, because when you're down, that means there's more buying opportunities. Like, just from my perspective now, like, finally, you could talk about stocks again because they're not at all-time highs.
We're back to stock picking. One of the things that really intrigues me is you'll get a Bank of America and you'll go on Stock Picker, and what people will say is, well, I don't have any more money. Well, and then I always say, well, if that's the case, then you're not doing it right. You always have to leave room. And if you really don't have any more money, then I think you've got to rethink what you're doing, because you're not keeping the cash reserve for the rainy day. You probably have other stocks that you don't want to sell because you're down on them. I mean, people have to recognize that if they have a finite amount of capital, they're going to take a beating at times. That's just what happens. And it's okay. You take a beating and you move on.
And I think it's important for people to realize, too, this is not 2000. We're not in like this dot-com bubble.
I mean, we're at 16 times earnings. Like someone, I happen to have, my good friend Aaron Burnett was doing this piece about whether in 87. Now, having traded in 87, the week before the day before the crash was the worst week the market had ever had. People always forget that. So go back 2 weeks, okay? What you will discover is stocks were trading at 28 times earnings. That's just way too much, particularly in a rising interest rate environment. We are not in that world.
All right, well, thanks a lot, Jim.
Thank you.
Psychology of loss.